This episode was co-produced by Startup Days, a yearly matchmaking event in Switzerland for startups, investors, corporates, and other key players. Check out startupdays.ch to learn more about this year's edition, taking place in Bern on May 25th. Again, that's startupdays.ch.
A lot of people, they always forget, I invest in a startup and in 1-2 years it's a unicorn and I make millions, right? This is not the case, right? I mean, we have to be honest also to the listener here, right? More than 90% of the startups, they fail.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. Here's your host, Sylvan.
Philippe, very well welcome to the Swisspreneur Show. It's a pleasure to have you here today.
Thanks a lot for inviting me. Pleasure to be here.
You're the co-founder and COO at Leva, the tech stack for the venture capital industry. Before we talk about venture as an asset class or startups as an asset class, we want to have a look at your CV. Whoever would look at your resume would have guessed or would have thought that you were on the way to become a very successful lawyer. But here you are today in the startup world. So what happened?
Well, I have not become a successful lawyer, that for sure. Yes, I also, when I saw my own CV, I realized I should have become a lawyer. This is also the career path that I intended to choose when I went to the university in St. Gallen. But in the end, I studied law and economics because I always thought law itself is too boring. Now, everybody that is a friend of mine and is a lawyer is going to hate me after they're going to see this. But I also was this interdisciplinary connection between economy and legal. And in the end, I have this entrepreneurial mindset. I always think outside of the box. Always trying to find solution on a pragmatic way, not just follow the act because the act says what somebody should do. We'll go into that a bit deeper later on. But the decision in the end was pretty easy. The decision was to join the law firm fully, or then my co-founder Cosimo called me and said, Philip, we need to get away from the blockchain. We go back into the regulated environment. Do you want to join this adventure? And I was like, okay, yeah, sure. Cosimo, I know you more than 15 years. So the decision was then easy. I wanted to make a change in the environment. And this is easier as an entrepreneur than as a lawyer.
I guess so, absolutely. Was this interdisciplinary thinking or area also what then sparked your interest in joining Leva, or what was the point that really got your interest to join Leva?
Absolutely. So Leva back then was on the blockchain, trying really to solve exactly what we still do, but with those buzzwords, blockchain, ICO and all the like. And what got me interested there was what they wanted to achieve back then. And it's democratizing the access to the asset class of venture capital. On the blockchain, super easy. Everybody like cowboy style does however they want. But they were just too early for the market. People did not know what it is, especially more sophisticated investor. They also stated too much regulatory tax-wise uncertainty. So the decision was taken to go back into the regulated world. And that was for me like the challenge, right? Going to regulated work, but keeping the DNA and core of Leva when it was on the blockchain, right? So everybody can use Leva, no matter if you have financial license or not. And obviously, the financial markets. I guess there's no market that has more regulation. And that was the challenging part where I saw, and I was, okay, let's crack that one. Let's legal engineer something out of it. And this got me interested in joining Leva at the end.
That sounds like a very, very big challenge to solve, but also a really exciting one. So now, 3 years on, how would you describe the startup journey?
Oh, God.
Where to start?
Well, okay.
Late night podcast interviews.
Yes. A roller coaster ride, I would say, with a lot of ups and downs, but obviously more ups than downs. I don't want to lie. There are downs where you face problems where you didn't even know where problems exist, either be it in your own company, people management, right? You come from university, you don't get those knowledge with you. How do you treat people? How do you manage people? Which is super important in a startup, especially when you're small in the beginning. But also, to be honest, the highs, they are high, right? Sure. It's like endorphins, like in thousands on levels. And this is what also keeps me up waking every morning to go and join the startups. So what did we do? We pivot away from the blockchain to a regulated market, normally on-chain, because we understood you don't need blockchain for what we're trying to solve. Mm-hmm. Then all those achievements that we gained, right? We received the confirmation that what we want to achieve is possible, even though all the law firms said it's not possible, save the money, right? A huge achievement when we got the result from FEMA that we are allowed to do what we do and we can serve the market. Then the top 10, one of the best fintech in Switzerland, and the top 100. So a lot of achievements, which you can just celebrate with the team.
Of course.
So also after 12 or 13-hour work, right, or 14, 15, staying in the office late, this is what keeps us up. So a roller coaster would describe it the best, I would say.
I fully agree.
Even though I'm super scared of roller coasters, but it would describe the best.
You don't write them, you have them in your life already.
Yes, exactly.
So today we do want to talk about venture capital as an asset class. And, you know, the stock market has had better days than what we see now in March 2023. Mm-hmm. We just entered a crypto winter, sort of. Mm-hmm. So are startups the future of investing?
They are definitely the future of the investing in sort of, if we talk of alternative asset classes. Mm-hmm. So the venture capital is definitely one of those alternative asset classes that will increase a lot in the future. I don't want to bore you with numbers, but is it the sole asset class? My answer is no, because you should not put all the eggs in one basket, right? But it will become definitely more important. And you know this, you have a lot of startups on your podcast. The problems with startups, right, is where do you start by evaluating what is a startup? How good is a startup? Is it really good for my portfolio, right? And there, obviously, the first challenges come, especially when you're a freshly new investor or on the founder side, you're raising funds, right? You have zero clue what to do. But I would say yes, definitely.
And if you look at it from a risk profile, you know, we know stocks are volatile, so they go up and down. You have bonds that are a bit more stable in normal conditions. So is investing in startups, is that more risky?
So I need to make advertisement for the whole startup economy. No, it's not. No, it's super risky. It's super risky. You know, it depends on which stage the startup is.
Right.
You know, you have early stage startups, you have seed stage startups, Series A, B, C, D, right? I don't know if you even call them startups anymore. So it depends, first of all, in which stage, right? Mm-hmm. Then, obviously, in which industry you're in. There are startups where the risk is higher, right? For example, you really groundbreaking new technology, new approaches. The risks are higher than, let's say, plain vanilla. I don't know. I want to bring new sockets out, right?
Sure.
So you need to evaluate, obviously, the whole investment as such as every investment you do, but it definitely belongs to the more risky asset classes.
But that has room in a portfolio because you are looking for a balanced portfolio with different asset classes.
Absolutely. I mean, if you look at the average, right, in Europe, I think you have 5 to 20% of your assets should be invested in alternative asset classes, right? Now, you can also start with startup and say, this is my sole alternative asset class, and then you grow. In the US, I think it's more than 50%, which is invested in alternative asset classes. So it's definitely a must because also it has become easier, right? Especially also in Switzerland, startups. Also, my grandmother now understands what a startup is, but it does not solve then to decide which startup is the best to invest, right? So absolutely, for a portfolio diversification, absolutely needed, as well as all other asset classes that you find.
And also just a quick disclaimer, what we're giving here is, of course, no investment advice. We just
very good.
a conversation amongst friends for informational and entertainment
Yes.
purposes.
Yes, we're not doing any financial advertisement. I know you got the lawyer in me. This is no public offering that we're doing here. You see, now already the challenges come, right?
Of course, yeah.
And these are all those small pitfalls, right? That either as an investor or somebody providing deals to investor as a founder, which you are challenged with.
Yeah.
Absolutely.
But nevertheless, let's say I want to start to invest in startups, right? Are there any legal requirements for me to become a business angel and really start to invest in startup companies here in Switzerland?
So legal requirements as such, as maybe our jurisdiction we don't have. I would, to be honest, also be a bit stupid if you would put like legal requirements on investing into startups. It's more like people that maybe distribute deal flows that might have legal requirements, depending what kind of asset class you have. So startup directly, no, right? But if you have, for example, a VC fund that invests into startups, those are usually structured in Luxembourg. Then you need a license to distribute them in Switzerland, right? So there, only accredited investors, for example, are allowed to invest. Again, I'm not going to bore you with the number what an accredited investor is, but there is this diversification between that. And I would say to start, it's just the right mindset that you need, right? You need to know it's a high-risk class of asset class that you're investing in. There's information asymmetry, right? There's no public information about the value of a startup, the revenue. Then it's also guessing, right? A bit, do you believe in what they do, the stage? The earlier you invest in the team, you don't really invest in the company, right? So there's all things that you need to consider. Then either you follow a group of people that already have done this, a community, syndicates or investment vehicles or financial advisors. I mean, there are so many out there nowadays. So if you start, you should definitely join one of those groups also to get a bit of learning of what is a startup and why should I invest in startups.
I like that you said that. It's more of a mindset thing. There are no legal requirements to get started, but it's really the mindset to put you in a good place to start, basically.
Yeah. And also, I forgot you need to have a long breath, right? Because a lot of people, they always forget. I invest in a startup and in 1-2 years, it's a unicorn and I made millions, right? This is not the case, right? I mean, we have to be honest also to the listener here, right? More than 90% of the startups, they fail, right? So you should invest money that you are allowed to lose. But this money that you might invest might help a startup to be the next disruptive thing, right? Sure. And this should incentivize you to invest. It's really pushing those startups in finding new ways to really push the boundaries, going into new markets, finding new disruptive ways on how to solve things and not to make money. This should not be your first motivation, to be honest. There are other things to invest in. Right. Your first motivation is money.
And talk about an investment strategy, even in startup investments, there can be a strategy, of course, or probably even should be. So what are good components to look at when you're setting your own strategy? Should you look at industries? Should you look at geographies? Should you look at the stage that you want to invest in? What should be the strategy or components to consider when setting your personal strategy?
So when you set your personal one, it's definitely two things. Your risk tolerance that you need to look first and your financial situation before you even look at all those things that you mentioned. Now, let's assume you have a bit of funds that you can place in the year. Then I would just invest in things that you're really interested in. Right. When you get interested, you also read about it. You read articles, you read blog posts, you listen to podcasts. You get to know also the whole industry. So industry that you're interested in. At the stage, if you have friends that now are raising funds for a startup, right? I would always support, obviously, first my close environment. Sure. So obviously, keep also touch to people that are really also trying to go the entrepreneurial way. on the stage itself, later stage, early stage, doesn't really matter to me.
That is your risk tolerance,
It's
right?
the risk tolerance,
Yeah.
exactly. I would say the earlier, the more risky, right? The later, then also the returns might be lower.
Sure.
From a geographic perspective, you might have regulations that stop you, right, to invest across the globe. But if you don't have them, I would just invest in every country which is possible. You think the next big thing will happen, and this is really up on you. Or if you don't have an investment strategy, you don't know what to do, it's your first time. I would just join a community of like-minded people like that will bring you to experience this investing part. If it's now for startup investing or other asset classes, you learn, right?
Exactly.
And then those people might have a strategy, or they don't have a strategy, but the common swarm knowledge, right, has a strategy, and this is a cool thing.
I like what you said about the personal interest, because this sounds very familiar to starting your own business. I think you have a huge advantage if you have the intrinsic motivation, and you also will have much more knowledge and understanding about that topic. So whether you're starting a business in that area or you want to invest in that area, if it's something that is close to your heart that you deeply care about, that's probably a very good starting point.
Absolutely. I mean, it's in startups, or if you buy a car or whatever it is, right? You do better decision the more you are informed. Sure. Now we have a lot of tools that help you, but the intrinsic motivation is the one that it is. And it's like if you just do it with passion, or you invest in things you like, you will definitely make less mistakes if you invest in things where you have zero clue what it is.
Of course.
Right.
Yeah.
So absolutely, I would completely sign this.
You said you need to have a bit of money to invest, obviously.
Yeah.
But is there any certain ticket size that you should consider per startup investment that you plan to do? Is there any such thing as a minimum ticket size, a best ticket size, or also a maximum ticket size that you should set yourself as a limit? I know this is very individual, but just wondering if there are any...
Yeah, perfect. It is very individual. So don't invest more than you can afford to lose. So this is like the main rule in
Number
every
one.
investment, right? Then there are two ways, right? The minimum ticket is usually defined by the startup, right? So they define what is the minimum ticket. That can be 10,000, 100,000, 500,000 or millions. Depending if they, for example, went through a crowdfunding platform, you also might be able to invest 100 Swiss francs, right?
Of course.
So this comes from the startup. Then depending if you join communities, syndicates or investment groups or investment clubs, right? They have their own minimal ticket, right? To be honest, if you have a bit funds on your side, I'm not talking about being the millionaire, I talk the average person, right? I mean, like 5,000 is a good starting point, right? And those 5,000 you can distribute among a few startups or in several startups. I mean, here it's really depending how much funds you have.
Of course.
But 5,000, I would say, is a good one. But I guess you will not enter serious startup with a 5,000 ticket. So you need to somehow find other people to pool and group all those mini tickets into a one big ticket.
Luckily, there are solutions out there to make that happen.
Solutions out there.
Before you said 90% of the startups fail. So what does that mean to me as an investor for my portfolio? Does that mean that I should at least invest in 10 companies within the first year or two? Or what is your recommendation there?
Yes, the broader diversification, the better it is. So if you just take my number, don't take this for granted. But if we say 90 to 10, then I mean, it's easy math. Do 10 investment, and one will happen, right? Hopefully. I always say hope is not a strategy. And I just ask, right? Investment strategy. So hope is not a good thing in the investment part. But I would say, if you start within a year, go for like maybe 5. Start with 5, then increase this. And then, as you said, start to diversify, right? Start to diversify maybe also industries, right? Let's say now, for example, the fintech sector at the moment, or bank sector, right? After what happened last weekend, maybe not the best sector to invest in. Now, if you have all your money in startups that are involved in that industry, and then you look at the values, maybe they're going to drop, right? So it's not good. So also there, start to diversify in the industries, maybe also in seed stages, later stages, and then obviously don't forget the other asset classes.
Makes sense. Now, there are also different legal structures that you can invest in, right? In Switzerland, if you talk about startups, usually and hopefully there's a limited or an incorporated company or GmbH or AG.
Always a good sign.
Exactly, hopefully. Otherwise, that's a big red flag that you should probably run away from. Do you have a preference there from an investor perspective? Because they are different.
Yeah. So if you want to have anonymity, it's clear you need to go for the AG. So there's no other way around. It also gives a certain professionalism to outside, to be honest. You have more flexibility on how also you're going to fundraise. You have a more strict governance. Yes, this is true. But now with the new Aktienrechtsreform, I don't even know how to say this in English.
Sure.
With this year's also there, you have a lot of flexibility that comes into the Swiss legal system. But it takes 100,000 to start an AG, or if you don't fully liberate like 50,000, but it's not really a good idea, right? Then you have the GmbH. You need less money. You can easily start. Maybe if you don't have external funding yet, right? So you don't have shareholders that need anonymity. So it's just the founders that are anyhow known that they own shares, right?
Sure.
Then you maybe start with a GmbH. And then you convert it into an AG later on. So here is really how much funds do you have in the beginning? Maybe also how sure are you in the vision that you want to bring forward, right? Or you want to burn directly 100K, or is it more than 20K? So maybe these are the ideas.
It's pretty clear from an investor perspective, AG is probably the way to go.
Yeah. I would definitely go, because just imagine investing also in a GmbH and you need to convert. There's again something on the investor tab we need to do. Then you have shareholder agreements here, shareholder agreements there. It's just too complex, right? The problem, right, that founders choose for GmbH is another one. It's just too costly to set up an AG, right?
5 times
Again,
more.
Lawyers are going to kill me, right? They just... I'm so sorry.
No, that's fine.
Right? They just earn too much on incorporating companies because, to be honest, I've done this job, right? This is just, you take a paper out to start. You don't need like this rocket setup of an AG. It is enough, and this does not cost a fortune. So if we can lower those barriers, maybe even digitizing it. There were some motions, right, into digitize the whole setup of an entity like other countries know it. It will definitely make it easier. And then I hope to see more AGs because it gives just more flexibility.
100%. So the take is pretty clear on the legal form. Another thing that is probably not that clear is the valuation part, right? This is always a huge discussions between the founders and the investors. And many say the valuation is actually a bit more art than science. How do you see that? How do you reach the right and fair valuation if such a thing even exists?
Look, if you would have asked this question 2 or 3 years ago, I would have said like valuation is just a gambling, right? I mean, look at the valuation of the startups 3-4 years ago, right? I mean, it's just nonsense. They were just shooting out numbers, and people were paying, VCs were paying it because the money was there. In what kind of situation are we now? You see more down rounds, right, than people doing like a high valuation the next round. This is bad for the founders. This is bad for the investors, right, for the motivation as such. So aiming always for high valuation is not the best. Now, back to your question, is it art? I would say yes, it is partially art because there are a lot of ways how to value your company, right? The normal valuation methodology that you use. Then you need to also maybe do comparison with other industries, with your competitors. Then you start to freak out because you see, wow, they're valued that much, they raised this much. So it's a combination of both, I would say. And in the end, it's more art in the startup world, I would say. Why? Because you need to convince the investors, right, that what you're selling is really worth today or tomorrow, right? But especially the team. So in the beginning, you're just evaluating the team, right? You're not evaluating the company. It's really evaluating the people, how they work together. And this is pretty difficult to do because no one out there tells you how to validate this. I can value the revenue streams, discounted cash flow, all those things. But how people work together, how do you value this? Right? So it is definitely an art, in my opinion, but has also a bit science behind, but it's more art, I would say.
And in the end, it's also supply and demand, right? If you have a lot of investors interested in your team or your case, you can sort of dictate the term to a certain degree. If that's not the case, you probably have to accept lower valuations because otherwise you just don't find any investors. So that's probably a bit
Absolutely.
your economic field that you're interested about, the supply and demand. Very simple.
In the end, it's super simple, right? The better your idea is, the better your team is, the better you convince investor, the higher valuation you receive. What I hear, for example, I hate to read this on LinkedIn, right? When people say we got overfunded.
Yeah.
To be honest, then you just miscalculated your value. Because how can you become overfunded if you did this job correctly, the demand, supply, and the yard, right? And I don't have zero clue why people celebrate this, because it just means, guys, you left money on the street because there were other people willing to invest.
Your valuation was too low.
Yeah. Might be, it was too low.
Yeah.
I don't know, the terms were too easy, but you left money and fund on the streets that maybe now with inflation, with the war and everything, with the crisis of the Credit Suisse, maybe it would be good that you did not lose the 200K or 300K.
Of course.
So you should definitely take this also seriously, right? I mean, we're laughing, but in the end, you're raising funds to then also be able to visualize and realize your vision. And in the end, you need also to pay the people that work with you, right?
Of course.
Yourself, and the funds, they don't come from trees.
Yeah. That's also a thing, talking about LinkedIn or the celebrations, just celebrating a fundraising round per se.
Yeah.
I mean, sure, you can see that as a milestone, but I think the real message there is, guys, you just took on a huge bet.
Yeah.
Now it's time to go to work and to deliver.
Yeah.
You can celebrate when you executed and hit the milestone that you were promising to investors that invested and took that leap of faith, right?
Yeah.
Then you can go out and celebrate and say, hey, we hit the plan, we executed well done, great job, team. But the fundraising round itself, it's like, okay, head down and work.
Look, you're poaching a notch at myself. We're in a society that celebrates everything.
Of course, yeah.
The sun is out, best day of my life, right? Next day, another sun is out, best day of my life again, right? So we lost a bit also to value exactly what is success and not. And sure, from a startup, doing a fundraising in every stage is difficult, especially now in the environment we are. We did ourselves the fundraising, right? The first tranche was super difficult, right? A challenging question. It's not like, here, we have a big vision. Yeah, here, take the money and burn it.
Right.
No, it's like, okay, but where's the profitability? Yeah. How do you get there, right? There are all questions that you did not really have 5 years ago. So I would say, it's correct what you say. You can celebrate the fundraising, right? That you achieved the goal, but then get back to work. But now people trusted you, right? That you and your team will get to that vision that you promised, right? Yeah. And then celebration, party one night, and then get back to work, I would say.
Time to deliver, exactly.
Time to deliver.
Now, I don't want to go into the terms, negotiating term sheets or all of that part. But one thing I would like to do is to name just a few of the strange terms that people who might look at venture capital as an asset class for the first time might just have never heard of.
Yeah, sure.
One very common one is the convertible loan. What is that?
The convertible loan, or maybe you also heard CLA or Wandeldarlehen or convertible note, and then Kiss Safe and whatever, right? They're all somehow similar but different. Yeah. And this is what lawyers love. They always find new vehicles so they can always explain what it is. Simple fact, it's a debt instrument that you give to a startup, so you give a loan, and then in the future it converts into equity based on certain criteria. Usually you have two. A valuation cap, so a maximum of a valuation when the loan is being converted into shares, right? So easy calculation, or you get a discount, so whatever is lower. These are the usual terms that you find in a CLA or convertible loan, and it's often used, especially in the early stage, because you don't need to do a capital increase, you don't need to go to the notary and all those cumbersome processes, right? It's contract, CLA, here's the money, loan, go for it. But it's also
very
risky.
Elegantly, no valuation. Of course, you have a cap, but no valuation to be set, which speeds up the process and negotiations tremendously.
Putting the founder head again, from the founder side, it's super easy because you just postpone the valuation.
Exactly.
So, for example, if I just made, on our case, what we did in the first round and now also in the second round, we separated. we went first for a CLA and then we go for an equity round. Why? Because in the CLA, we want to get in the smart money. So people that also help us push the business, bring in the knowledge, and they should also be rewarded for it, right? So they get this cap, so the maximum valuation or the discount. It worked on our first round, and this is how we also structure the second one. And yes, we don't need to talk about the valuation as such, but still, they ask
Of course.
the cap. Because the cap is then also the reference for the equity round, right? So how do you come to this cap, right? And now, also in this industry we're in and the environment, also in the CLA, it has become more challenging.
And you said there are also risks associated with the convertible loan agreement. What are the risks?
Well, I mean, you just give a loan, right? I mean, if the startup fails and usually you give it, you have nothing. You have absolutely nothing, right? I mean, even in the risk class, in the bankruptcy, right? You're in the last one.
Sure.
So you don't have any shares. You have nothing in your hand. It's just a loan. And typically, they also have interests, but also those interests are being converted. So you don't really get nothing out of it until it is really being converted. But you get lower valuation, right? So you get more favorable terms than in the equity round, and then you're ready, theoretically, right, on books, you already made a plus.
Yeah. There are three more I want to talk about.
Yeah.
One really crucial one to understand when you go into venture as an asset class is liquidation preference.
Yeah.
What is it and how does it work?
Okay, I'm going to give you the easy answer because it is complex, and usually you find this in equity rounds, and you find this in the shareholder agreement. And liquidation preference, put it easy, is there are certain investors that get the money first in case the company is being sold or in an exit. Yeah. So just imagine this: a startup, as we say, has different stages, right? In every stage, people invest and then ideally get shares. Yeah. The person that follows always tries to negotiate better terms for him or herself. Yeah. And usually then liquidation preference come in, right? Yeah. They say, look, before you pay out the first one here, you pay out me. Yeah. And then usually you have a multiple. So you pay out the minimum investment I did, multiplied by 3, and then only the rest is allowed to to receive the funds. Yeah. And now this is really one of the most important things to look in those startups, right? Investment. It's all those tricky things because imagine you're in the late stage. You start in the beginning. Yeah. Then in the late stage comes, I don't know, this super big VC, gives himself a liquidation preference, multiplied 4 times. Then you have another one 3 times, 2 times. Then you read, this startup has done like a 2 billion exit. And you're the last one here. And then you say, shit, there's no money left. Everybody took it in front of me.
Right.
Right.
Founder built a hugely successful company, but end up with nothing.
And ends up not because founders are here.
Exactly.
So in the chain, right, is in the beginning. Yeah. And if you don't really are careful as a founder, really, theoretically, you can lose your company, right? And you've built something up, and in the end, you're not getting rewarded for it. Yeah. And as an investor, if you don't take care in looking exactly at those specific terms, they're easy understandable, right? Once you understood them, but you need to understand them because otherwise you might invest in something and in the end you don't even see anything out of it.
Yeah, but that's great to know as an investor because that's where you will have negotiations about. Yeah. What I consider fair from the outside perspective, I understand why liquidation preference exists. Yeah. I think a 1x liquidation preference is fair to give the investors the money back first because they give you the money, you work, you get shares to work in the company, maybe also invested a bit, but nothing above 1.0, especially for early stage. But that's my take.
Look, I'm a founder. I would sign this, but also nowadays, right? Yeah. The environment is harder. Now, of course, the market is on the investor side. They determine the terms at the moment, right? Yeah. So if they say, look, I give you money, but I want a 2x. What do? Do you take the money? Do you go again for fundraising? The more you're in the fundraising, right, you cannot work on your operating company, so you're not driving the value. It's crazy, right? Yeah. Investors, they want to give you money to drive the value, but simultaneously, they then also negotiate those terms. Then, you just say the simplest one. Then you have participating, non-participating, liquidation. And then it becomes complex, right? And you need to understand those terms as a founder to maybe not get tricked into deals that you don't want, right? Or terms, but also as an investor. Sure. You need to understand or, again, have a community that understands it.
Yeah. In the end, it's de-risking your investment from an investor's perspective. Yeah. The third, I want to talk about is drag along and tag along.
Oh, God.
We hear about that often, but what is it actually, and why is it relevant for investors?
Maybe the tag along, which is easier, right? It's a minority protection that you have. Simply put on paper is if a certain threshold, which is defined in the shareholder agreement, right, is being sold, so the certain threshold of the company, of the shares is being sold, you as a minority are allowed to sell with, right? On the other side, whoever buys needs to buy, right?
And that is important, right? Because if you're an early stage investor, you usually have a very small stake in the company. And if the company gets sold, you don't want them to take over the majority of the company and just let you as investors sit on worthless shares that don't get a liquidation event. That would be the worst case scenario.
Absolutely.
Right?
Absolutely. And this is exactly why this clause exists. Also there with 1,000 exemptions, how you can write, but the easy explanation is that one. And the other one is just the opposite, right? It's if where we're tag along and the drag along is if somebody sells a certain amount of shares, right, that you need to drag along, you need to put your shares, so you cannot block an exit or those kind of things. So it's more also from a protection from a founder perspective, and maybe also from majority stakeholders, that those small investors cannot just stop any transaction.
It's actually cool. Your legal knowledge and background combined with the founder knowledge. It's actually fun to talk about these topics,
It makes fun, right, to talk about legal. Inside our startup at Leva, I trained like all those techies to legal experts, right? And it's just how you translate legal to people that have not studied law. And this is often what lawyers forget, right? You don't have people that have studied law on the other side, and you should not take advantage out of it because you can explain all those terms in an easy way. You don't need to go like those legal jargons that nobody understands. And it makes life easier of an investor when he knows what he does. It makes the life easier of a founder when they know what they do, right? And the whole ecosystem. If they just understand what they do, right? And legal is not difficult to understand, right? If you not become lawyer, then it's the best way to do it, in my opinion.
I like that. So now we talked about some legal jargon that might come up when you invest in startups, most certainly. But now the most important question. So I say, cool, I understand venture capital is an asset class, but now I really want to get started. I want to do my first few investments. The biggest question here, the biggest challenge is, how do I actually get access to deal flow? This is tricky.
It is. I guess this is the most difficult part, is a good access of good deal flow, because you get access to deal flow, but a good deal flow. This is the tricky part. So this is definitely one. And then also maybe investors that you want to join the group with. Maybe the usual things, go to events, startup events. There's now one cool at St. Gallen, the Start Summit, which is led by students. Just a thing I love was that the International Students Committee running the St. Gallen Symposium. I just love things that are run by students, right? Super cool. So currently happening in St. Gallen, join there, and you're going to meet a lot of startups, which is in the end a deal flow, right? Because every startup is raising always funds somehow. Then you can go to accelerator events, networking events. Then you can go on crowdfunding platform theoretically, where maybe you start to get a touch and feel of what a startup is. Or you can also join groups, right? They are focused on investing into startup, right? Syndicates, for example, investment clubs, clubs in general, whatever terms they all use, where you join a group of like-minded people that one of them might have a deal flow, right? And shares it with you. And I guess to start it, this is one of the best examples, is those syndicates, right, that are popping up left and right and are really just taking advantage of the swarm knowledge. They do the deal flow, they share the deal flow, they select some deals and then present it, right? And then it's up on you to decide if you want to participate or not.
Exactly. So yeah, there are many different ways to get involved. Maybe just to understand that a bit better, I can directly invest into a company, usually probably with higher tickets because the companies don't want to mess up their cap table. but I can also invest through a syndicate. So what is the difference there if I invest directly as a private person or through my own company versus through a syndicate?
So if you invest directly, as you just said, right, you buy the shares directly in the company, you have your saying in the company, depending how big your stake is that you buy, you get a board seat, but also you influence decision on a strategic level when there are general assemblies. But usually a high ticket is needed, right? Plus you need to know which startup you're raising. Now, if you start with it, if I just follow a bit the history, what we discuss, so you don't know what to do, right? Then it's usually joining a syndicate or investment club. And what does this mean is that usually how those syndicates are structured is that somebody is representing the syndicate and is doing the legal heavy load, right? Discussing the terms, negotiating. And then on your side, right, an investment vehicle or investment structure is being put in place and you participate in that one. So this is maybe a good thing to also separate, right? If you invest directly or indirectly, if you invest indirectly, you don't own directly the shares of the company. So these are the main two differences. Then again, depending on how this investment vehicle is structured, you have again shares or not, right? But this is a two difference.
And what would you say are the benefits of investing through a syndicate?
I mean, there are tons of it, and I want just to follow the story that we're in here. So diversification of your portfolio, for example, right? You start in the investments, in case of a startup, you join a syndicate that, for example, presents monthly or bi-monthly deals. Usually syndicates, they take on an allocation. Right, in a startup, let's make an example. There's a startup raising 2 million and says, look, the minimum ticket is 1 million. Okay, so you know 2 entries in the capital. This is what they want. So who has 1 million?
Some people
have, but that's not the majority, right? How many people have 1 million to invest? Even less. Plus, you should not invest all your money in one goal. So what usually then happens is somebody takes this allocation and breaks it down to a syndicate, right? So breaks down the minimum ticket, takes maybe the allocation, does 2 syndicates, 3 syndicates, right? With different allocation because maybe you're facing different people. So benefit is you have definitely a lower minimum ticket you can invest, right? That you have a diversified portfolio of investment. You have knowledge shared knowledge, right? This is the right term. With people leading, for example, the syndicate, they do deal valuation, right? They talk to the founders, they talk to the startups, to the team. So you're not so blindfolded. Plus, if we go across assets, then right, you can start mixing up your portfolio without going too much into the risky fields, because you keep your minimum tickets low. And then, obviously, depending which community you're in, you're more successful than the other ones. But that would definitely be the advantage that pops up right in my mind.
And who are usually the people who use or invest in syndicates? Is this like the small private investor, or is that also like big VC funds or pension funds, or who actually uses syndication? So
I don't know exactly the year, but I mean syndicating, this was done back in the medieval time, right? So it was always a type of a sort to invest. And what does a syndicate mean, and not like the criminal things, right? Is people coming together with the same purpose, right? And doing something. Now, in this case, an investment syndicate is investing into something where they have a shared belief that this is a good idea. So it's being used for business angels, private individuals, students, PE firms, VC firms, investment bankers, family office. They all syndicate. Banks syndicate loans together, right? So there are a lot of players that syndicate, and recently, I would say the last 5 to 10 years, it started more in the US, right? This syndicating into startups, right, has become this flourish topic, right? And now we have seen this also in Europe and Switzerland. It's getting started, and there you just have the benefit, right, that you're just not by yourself, right? You join this community, you take the decision still by yourself, right? If you want to invest, but you're not alone, and this is definitely a plus.
I like that because it sort of lowers the entry barriers to a certain degree. that, we saw in 2022, there were almost 4 billion invested in Swiss startups. But that way you sort of see how you can grow the pie bigger for the ecosystem, that more people who otherwise would not have access or who wouldn't meet the minimum ticket size of the company can now also invest in startups. So this is a great way to grow the pie and to have more money flowing into Swiss startups.
Absolutely, because you untap a whole market that has yet not deployed the funds, right? Yeah. So you give this fund to the ecosystem, and this is a huge benefit for the whole ecosystem, right? Every founder applauds and say thanks you very much. But also, depending on the country you're in, right? You want to boost your technology, your new development. You don't want to be stuck in the sectors you've been there for centuries. Yeah. So absolutely, this is a huge advantage. Plus, you empower the individuals in taking control of their financial situation. Plus, if it's in a community, you empower the communities. And this is what I love about those syndicates. It's just you give back the power to the people, right? Because syndicates nowadays, they can work like VC firms, right? You can really flourish a syndicate to a VC firm if you want. Right. And you don't need to rely on people that you don't know, right? I mean, Cosimo, my co-founder, I know him for 15 years. In our circle, we have 6 friends from the HSG that all started a startup. We know if a startup is being pushed out of the HSG, of EPFL, ETH, before any VC knows it, right? Yeah. You have great access. I mean, let me make this example. Your listeners, right? Your listener is your community or a Swisspreneurs community. This can become a syndicate or being a fund. I mean, just imagine all this. This is the nice thing. And this is why I would not limit it who can use the syndicate or not. Sure. It's like everyone can use it, but it definitely benefits those that have yet not invested in those asset classes.
Fully. And if you look into the future, what sort of trends or development do you see? Where are we headed with the venture or startup investing in Switzerland?
I mean, we're nowhere, right? Again, if you just look the number, the numbers will just increase. If you looked the funds that will be deployed, right? You think how many startups, like who's going to work in corporate if all those funds are being deployed, right? Everybody wants to be an entrepreneur. Yeah. So definitely what I think is happening is more entrepreneurship, right? Which is a good thing. Switzerland was always an entrepreneurial country. I think we're the country with the most KMUs around the world, right? So this density. This is something definitely what I see in the future. From an investor side, it's obviously getting access to those alternative assets, but also ways that facilitate to invest either directly, right? You have all those tokenized movements out there, right? But again, technology that you might not understand. But what is happening now also is the facilitation, right, of setting up syndicates, of running syndicates, of running a fund, right? You lower the barrier to go into that direction. And I think this is a huge benefit for the whole ecosystem if all those swarm knowledge and swarm funds, right, come together.
Yeah. So you predict that there's more funds being deployed in venture as an asset class.
Yeah, absolutely.
What role do pension funds play in that regard? Because there, especially in Switzerland, we see huge potential that is not yet really leveraged and deployed into venture.
Absolutely. I think it was last year or this year. We're already in March, so I don't know. Usual context of founders, they don't even know in which day they are, right? I think it was last year when the government decided that pension funds or pension schemes are allowed to invest a portion of the assets that they manage into startups or in the startup ecosystem. I think it's 5%, 4%, something like this. Not much, but if you think how much the pension scheme are sitting on, is a lot. Yeah. I hope, right, that they also take this opportunity and do it, right? I mean, you have seen, you can invest in Credit Suisse, it can go bankrupt in 2 weeks. Or you compare it 6 years ago, 80 Swiss francs, now almost nothing. Same as a startup, right? So why don't take this faith leap and this jump in providing also the funds to this ecosystem? Because put Switzerland on the table and compare it with Europe and the US, then we're absolutely nowhere. Yeah. Right, and this is also something we should be clear of, right? We always say Switzerland is a great country in the funding and everything. Yes, but if you just look at the values and not the per capita and everything, right? it's really, we're listening to other founders. They always compete cross-border. They don't compete in Switzerland, right? So we have a wealthy country, right? We are sitting on funds in the pension, but also in your own pockets as a company. There are a lot of corporate ventures also now emerging that bring in new funds. Syndicates, right, are emerging, people that come together and instead of, I don't know, spending the fund by itself, they group the funds and invest. And this is what will boost the ecosystem in Switzerland. So this is the funding part, absolutely. And
sometimes we are a bit too comfortable in Switzerland, right?
Oh, yeah. As an investor,
yeah, also.
we're very comfortable because we expect the startup at seed stage already to be the super profitable company, right? They always forget venture capital. They forget the two words, the capital. Right. So you need to fund and venture, right? Translate in German is Wagnis. It is still venture, right? So you cannot have all the safety nets that you want, right? You need also to trust your gut feeling and the art of the valuation and invest. And in the end, this is, you need just to take the whole pie, right? And look, how can you make it more efficient? And on the founder side, it's, you can have the 9 to 10, 9 to 12, 9 to 13, but it comes down while you maybe do 9 to 5. You have in Asia people running startups that do 9 to 9, right? So it's 24 hours. I'm not exaggerating. On your side, you have maybe 6, 7, 8 hours, right? I mean, they will just produce more, right? Not saying better, but more. So we just also should get out of this comfort chair and say, okay, we're living in this wealthy country. Yes. But how did it become so wealthy, right? As I said, we're an entrepreneurial country. And they were not there sitting just, okay, let's wait until the rain is coming with the funds and with new ideas. No, they were pushing forwards, they're pushing boundaries. And this is what Switzerland was always proud of. So we should definitely learn a certain amount of humbleness. That is definitely a good thing.
I like that, but also think bigger and be more ambitious and get out there and make the pie bigger.
Yeah.
There's still so much work to do, and we shouldn't be happy with where we are, but push harder and go further.
Yes, this catchphrase to work with each other, right? I hear this at every startup conference. All right, we need to work together. We need to make the pie bigger, right? Yeah. And then the conference is over, nobody wants to work with each other. Right? Everybody is building its own cake, right? Because, oh no, wait a second, you have this idea. No, you could steal my idea, right? Yeah. Look over the sea in the US. Yeah. They collaborate. Even competing startup, collaborate on the board level, right? They talk with each other. What kind of a problem do you have? How did you solve it? Okay, let's solve it like this. In Switzerland, we always think, let's make first the small pie big, right? And then think about how to make the money out of it. And instead of really just looking at the ecosystem of Switzerland, make the pie big on the founder side, right? By being going up for startups, a lot of startups, but also from an investor side, right? Yeah. Just make the pie big, because if the startup that you're backing, right, or has been validated, you're backing and is going for a unicorn, there will be tons of money to make out of it, right? But I said in the beginning, pushing or investing into startup, your first motivation should not be making a lot of money out of it, right? Obviously, it comes with it, right? But just bring this ecosystem to a level that also really is also able to compete with the others. And there was really a shout out to all founders and investors to really take this not as a catchphrase, let's work together and then nothing happens, right? There are a lot of initiatives happening, but I think there can be even more.
Absolutely. So, Philippe, to wrap up the conversation today, we have some rapid fire questions for you. I give you a short question or different options to choose from, and you have to answer in one sentence.
In one sentence.
You ready?
Yeah.
What's a huge investment red flag?
A company with a high burn rate and zero plan on how to become profitable.
Yeah. How many hours of sleep did you get last night?
Let me calculate. I usually go to bed at midnight, wake up at 4:35, so 4.5 hours plus minus.
Wow, that's not a lot. Does entrepreneurship make you happy?
One sentence, yes. It makes me happy, even also the lows I will find ways also in the lows to find positive thought. And it's always the lows is you learn.
You enjoy the ride.
Yeah, I enjoy the roller coaster ride even though I'm scared.
Founder or investor?
Founder.
Describe the future of Leva in one word instead of one sentence. Even harder.
Exciting.
Cool. Philippe, thank you so much for taking the time. I know you had a really busy day. You were all day at Start Summit, but here we are, 10 p.m., recording this session. So thank you so much for stopping by and for being here and for sharing all your knowledge and insights. And again, no investment advice, just information purposes. Philippe, thank you for being here and all the best for the future.
Thanks, Silvan, and also to the whole Swisspreneur group for inviting me, also representing Leva here in your podcast. You're doing a fantastic job with it. This is what I mean, right? Empowering communities through listeners, through voices. This is exactly what Switzerland needs.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.